Welcome to the Financial Markets course. I'm your instructor here to guide you through a structured and immersive journey into the world of finance. Over the coming weeks, we'll explore how financial markets function, the tools investors use, and the frameworks professionals rely on to make decisions in a dynamic and competitive environment. Let's begin with a simple but powerful question. What are financial assets, and how are they different from real assets? At its core, a financial asset is a claim, a legal and economic right to receive future cash flows. It does not represent physical ownership. Instead, it's a right to income that will be generated by something else, usually a real asset. Compare that with a real asset, which is something tangible, a house you own, a farm, a car. Now, let's connect the two. If you rent out your house and sign a lease agreement, that contract becomes a financial asset. It gives you a claim on future payments backed by a real asset, the house itself. In finance, we mostly work with financial assets, but we always remember every financial asset is ultimately backed by something real. In professional jargon, financial assets are often referred to as securities. So if you hear someone talk about trading securities, just know they mean financial instruments like stocks, bonds, options, futures, swaps, and so on. Why financial assets matter? You might wonder, if financial assets are just contracts, why are they so important? It's because they allow us to move resources across time and across scenarios. Let's break that down. Suppose you earn a lot of money today, but don't need to spend all of it right away. Financial assets like savings accounts, stocks, bonds allow you to save and grow wealth for the future. Think about retirement plans or investment accounts. They all serve one key purpose: helping you transfer purchasing power from the present to the future. Now imagine the future isn't just about time, but about uncertainty. What if you lose your job? What if your house burns down? What if there's an economic shock? Financial assets help you survive unexpected events. They smooth your well-being not just across time, but across different states of the world, good and bad. So to sum up, financial assets are the tools that allow planning, protection, and prosperity in an uncertain world. Let's now zoom into how financial assets are categorized. We group them into what we call asset classes. These are broad categories of assets that share similar characteristics. You'll hear this term all the time. Which asset classes do you trade? Or how do you allocate across asset classes? There are five main asset classes. 1. Fixed income or debt. This class includes instruments like bonds or loans. Here, you're not buying ownership. You're lending money and expecting interest in return. The name fixed income comes from the traditional structure regular fixed coupon payments. You'll often hear short-term instruments, money market, long-term bond market. 2. Equity. This is about ownership. Buying a stock means owning a piece of a company. Equity holders have a claim on profits typically through dividends, but also take on risk. 3. Foreign exchange, FX. This class involves currency trading. Whether you're an importer hedging future payments or a speculator betting on USD per TND, this is the domain of spot and forward FX trades. 4. Commodities. These are real physical goods that are traded in financial markets. Think gold, oil, soybeans, or cattle. Commodities are essential to global trade and are often used as hedging tools. We divide them into softs, agricultural products, e.g., sugar, cocoa, precious metals, gold, silver, etc. Energy, oil, gas, electricity. 5. Credit markets. These focus on the creditworthiness of borrowers. Unlike fixed income, where we focus on interest rate sensitivity, credit markets deal with default risk. You'll encounter instruments like corporate bonds, credit default swaps, CDS. These instruments can act like insurance, for example, protecting against a company's failure to repay its debt. In the world of finance, timing is everything, and that's where we introduce two essential trading frameworks: spot markets, futures, or forward markets. Let's define them. Spot market is the market of now. You agree on a price today, and the transaction happens immediately or within a very short settlement window. Example: you walk into a currency exchange and swap euros for Tunisian dinars. That's a spot transaction. In FX, the typical settlement is T plus 2, meaning the actual cash and currency exchange happened 2 days later, but the trade is executed and agreed upon today. Futures market here, You agree today on a price, but the actual cash flow and delivery happen later. This is essential for businesses that want to hedge future risks. Take a car importer. They'll receive vehicles in 3 months and must pay in euros. But what if the euro to Tunisian dinar rate changes drastically by then? They can enter a futures contract to lock in today's exchange rate, removing uncertainty. Spot is about now. Futures are about protecting the future. And yes, you take risk either way. If the market moves in your favor after locking the price, you lose potential gains. But if it moves against you, you're protected. Futures pricing is derived from spot prices, and we'll dive deeper into those mathematical relationships later in the course. Let's now explore two fundamental layers of market activity. Primary market. This is where new securities are issued. The company itself is selling shares or bonds for the first time, directly raising capital from investors. When a firm like Taraji Holdings sells new shares to the public through an initial public offering, IPO, that's the primary market in action. Only the issuer receives money here. Secondary market. This is what you're more familiar with. It's where existing securities are traded among investors. When you buy Apple stock on the NASDAQ or Buyat stock on the Tunis Stock Exchange, you're buying from another investor, not from Apple or Buyat. The secondary market provides liquidity, it lets you exit investments, and it gives real-time feedback about the value of financial assets. One of the more complex and fascinating innovations in finance is securitization. What is it? Securitization is when a financial institution bundles a portfolio of loans like mortgages or car loans and transforms them into a new tradable financial instrument, a bond. These instruments are called MBS, mortgage-backed securities, ABS, asset-backed securities, or more broadly, structured products. The original bank gives out loans. Then instead of holding them, it pools them into a portfolio, structures them into tranches, slices based on risk, and sells them to investors. This creates liquidity and transfers risk, but it also requires transparency and regulation, as history has shown. Yes, we'll talk about the 2008 financial crisis later in the course. In Tunisia, securitization has been rare. Bayat executed two operations back in 2010, but it hasn't become a mainstream tool here yet. Now, here's a distinction that often confuses newcomers. Public equity, which refers to shares listed on public exchanges. Anyone with a brokerage account can buy them. Examples: Apple, Tesla. Private equity involves investing in non-listed companies. Deals are negotiated privately. Minimum investment is often in the millions. Public equity gives access. Private equity gives control. Both have advantages, but they require very different skills, capital, and timelines. You're beginning to see the full map of the financial system. Now let's start walking deeper into its mechanics. Who are the players in financial markets? Understanding who participates in financial markets is as important as understanding how the markets work. Let's break down the ecosystem. 1. Households. These are individuals like you and me. We typically act as investors looking to grow wealth or savers seeking to preserve capital. Sometimes we also borrow through mortgages, loans, or credit cards. Second, firms, companies. Companies are often on the other side of that trade. They raise capital by issuing equity or debt, invest in projects, and sometimes manage large corporate treasuries. 3. Governments. Governments are major borrowers and lenders. They issue bonds to finance spending, manage sovereign wealth funds, or stabilize economies through monetary operations. 4. Financial intermediaries. These are the true engines of the system. Commercial banks, investment firms, insurance companies, asset managers, pension funds. They connect people who have capital with those who need it, taking fees or spreads in return. And 5. Investment bankers. Think of them as architects of the capital markets. They help firms go public, initial public offerings, issue bonds, merge or acquire other companies. In Tunisia, this role is often performed by specialized departments within brokers like Tunisi Valeurs, and if you're wondering where you might fit, don't worry. That picture will become clearer as we progress through this course. 6. Then the last part is venture capital and private equity. The difference is that venture capital are actually way riskier than private equity. Venture capital invests primarily in startups, so it's smaller tickets, much higher risk. The main difference is the size and the degree of risks, so that's why I put them together. Let's focus now on risk, return, and the efficient market puzzle. Finance always comes back to one equation. Higher returns require higher risk. Let's unpack that. If you invest in a government bond, your risk is low and so is your return. But if you buy shares in a tech startup, your risk skyrockets and so does your potential return. Throughout this course, we'll explore how to measure risk, standard deviation, value at risk, how to compare assets on a risk adjusted basis, and how to build portfolios that balance both. And here's a key idea we'll keep revisiting. Are markets truly efficient? If they are, then prices already reflect all available information and you can't beat the market. If not, then skilled analysts and traders can find mispriced assets and generate alpha. You'll eventually be asked, do you want to be an active investor trying to beat the market or a passive investor tracking it through diversified portfolios? The answer may surprise you. Let's end today's session with one of the most powerful mental models you'll use in this course, the V-Diamond model. This model integrates two major approaches to investment. Private equity approach, top-down. Start with macro analysis. What countries or regions are attractive? Then examine the business cycle. Are we in a boom, recession? Next, choose a sector aligned with the cycle. Then look for promising firms to invest in. This is how private equity professionals decide where to allocate capital. Capital market approach, bottom up, begin with the company. Analyze its fundamentals, financials, and valuation. Then consider industry position and risks. You may ignore the macro picture. If the asset is mispriced, that's your opportunity. In this course, you'll learn how to combine both, hence the diamond structure. Top-down tells you where to hunt, while bottom-up tells you when to pull the trigger. The best investors use both perspectives, and you will too, especially in your project work. Guys, no modern finance course is complete without a word or three on fintech. Fintech, financial technology, is a broad category that includes peer-to-peer lending platforms like Lending Club, robo-advisors that automate investment decisions, AI tools that help analyze markets or generate trades. But perhaps the most talked about branch is this, blockchain. This is a foundational technology not the same as crypto. Blockchain enables the online transfer of original ownership, not just copies. Think of sending a PDF file. You keep a copy, I get a copy. But with blockchain, you send me the only original version. That's a breakthrough. It opens the door to smart contracts, digital currencies, decentralized finance, DeFi, and yes, cryptocurrencies. So what's the difference between these? Blockchain is the underlying technology, while cryptocurrency is a digital asset built on blockchain, and digital currency may be issued by central banks, not always blockchain-based. As we'll discuss later in the course, blockchain may not replace traditional finance, but it's certainly reshaping it. Let me close today with a few final thoughts. This course is more than theory. It's a 13-week simulation of real-world finance, and most importantly, a test of your resilience, curiosity, and drive. We'll support you, challenge you, and give you tools that professionals use daily, but we can't give you the fire. That has to come from you. As you finish reviewing Chapter 1 and preparing what was covered during your first full session, print this in your mind. Resilience beats brilliance, always.